How and why due diligence is changing. The due diligence period is one of the most important parts of buying a restaurant. It can also be one of the most stressful stages for both the buyer and seller. Over the past decade, due diligence timelines have become shorter while expectations for documentation have increased. Buyers can now receive detailed financial and operational information faster than ever, but they still need to know what information matters and how to evaluate it. What is due diligence? Due diligence is the period between signing a purchase agreement and the deadline established in the contract. Depending on the size and complexity of the restaurant, the period may range from approximately 10 to 30 days. This is when the buyer confirms that the restaurant is what they believed they were purchasing. The buyer reviews financial records, lease information, equipment, operating expenses, licenses, and other details that could affect the transaction. Due diligence periods have become shorter for three primary reasons. Electronic document delivery. Documents can now be uploaded to a secure shared folder within minutes. In the past, buyers and sellers often met in person to review paper ledgers and boxes of records. Digital financial reporting. Most bookkeeping, point-of-sale reporting, tax filings, and payroll information is available electronically. Sellers can quickly produce sales reports by month, week, day, or day part. Franchise resales. More quick-service franchise locations are being sold. Franchise systems typically require standardized reporting and operating procedures, making important information easier to locate and review. Why due diligence is critical. Due diligence is often the most information-heavy and decision-intensive part of the acquisition process. It gives the buyer an opportunity to verify the seller's representations or identify information that changes the economics or risk of the deal. Due diligence should not be confused with lending approval. At We Sell Restaurants, financing is generally addressed through a separate contingency. A buyer may complete due diligence successfully, but still be unable to obtain financing based on the lender's cash flow analysis or underwriting requirements. Separate due diligence and lending contingencies can provide buyers with multiple layers of protection between contract signing and closing. Using AI during contract negotiations. Artificial intelligence can help buyers organize information, review financial data, and develop questions. However, buyers should be cautious about using AI as a substitute for qualified legal counsel or an experienced certified restaurant broker. In one recent transaction, a buyer repeatedly stated that an attorney had reviewed the asset purchase agreement and recommended numerous changes. However, the attorney was never included in an email or conversation. Instead, revisions continued to arrive directly from the buyer, one change at a time. Many of the proposed revisions did not strengthen the buyer's position. Some removed protections or shifted additional expenses to the buyer. At closing, the buyer was surprised by costs that resulted directly from the contract language he had requested. In another transaction, a buyer submitted extensive revisions that created conflicting deadlines. The agreement required the transaction to close within 30 days, but allowed 45 days for due diligence. This would have allowed the buyer to continue reviewing the business after the scheduled closing date. Conflicts like these can create confusion, delay the transaction, and require substantial rewriting. AI can produce professional-looking contract language, but it does not understand every transaction, local requirement, or practical consequence of a proposed revision. Buyers should use it to generate ideas, not as a replacement for professional legal guidance. Using AI for due diligence checklists, AI-generated due diligence checklists are also becoming common. Some are useful, but others are designed for multi-million-dollar mergers and acquisitions rather than the purchase of a restaurant. A broker may receive a 5- or 6-page checklist for a restaurant listed for $90,000. These requests can include documents that provide little meaningful protection to the buyer. For example, a checklist may request receipts proving that every piece of equipment has been paid for. In most transactions, the closing attorney conducts lien searches to determine whether claims exist against the assets. Years of equipment receipts may not add meaningful protection. AI also struggles to distinguish between different types of restaurant acquisitions. When purchasing a profitable operating restaurant for its cash flow, historical sales, expenses, and earnings are critical. When purchasing an asset sale to convert the space into a new concept, the seller's financial performance may be less relevant. A struggling sushi restaurant may provide very little information about how a new sandwich shop will perform in the same location. In a conversion, the buyer may need to focus more heavily on equipment condition, lease terms, occupancy costs, utility expenses, licenses and permits, location suitability. Experienced restaurant brokers tailor due diligence requests to the size, structure, and risks of the transaction. AI generally creates broad, standardized lists. That distinction matters. Sellers continue evaluating buyers throughout the transaction. A 14-page request for a straightforward asset sale may cause a seller to question whether the buyer is likely to close. Rather than spending weeks responding to unnecessary requests, the seller may choose to work with another buyer. A well-prepared buyer asks thoughtful questions that are appropriate for the transaction. What happens when you find a problem? Nearly every buyer finds something during due diligence. The question is whether the discovery materially changes the transaction. Not every issue justifies renegotiating the purchase price. A piece of equipment that may need replacement in 2 years is not necessarily a reason to reopen negotiations. A health code violation that was corrected immediately is different from a pattern of recurring violations. An add back that cannot be documented to the exact dollar is different from evidence that revenue was overstated. Buyers should ask, does this information materially change the restaurant's economics? Does it change the level of risk? Would I have made the same offer if I had known this information earlier? Material issues could include revenue that does not reconcile, significant lease problems, equipment in worse condition than represented, or the unexpected departure of a key employee. When a serious issue is discovered, the buyer should work through the certified restaurant broker rather than approaching the seller directly. The broker can help determine what the discovery means, identify available options, and communicate the concern in a way that encourages resolution rather than confrontation. Some findings may be deal breakers. That is exactly why the due diligence period exists. The goal is not to close every transaction. The goal is to close the right transaction. At We Sell Restaurants, our certified restaurant brokers help buyers understand which concerns are serious, which are routine, and how to keep the process moving toward a successful closing. Ready to find the right restaurant? Connect with a We Sell Restaurants certified restaurant broker or search available restaurants for sale at WeSellRestaurants.com.